The IRS has never audited a private jet the way it audits your $340 side hustle deposit. That's not an accident. It's the entire design of the system, and once you see it, you can't unsee it. The tax code isn't one set of rules. It's 7 or 8 completely different games, and which game you play depends entirely on which zip code your income lives in. Same country, same April deadline. Wildly different experience. Let's walk through what actually happens to you, in your body and your bank account, at every level of income from $0 to $100 million. Here's what's actually being measured. Not how much you earn, how much of your income comes stamped with a W-2, because that's the income the IRS can see before you ever touch it. The system was built around a factory worker in 1943 who couldn't hide a paycheck. It still runs on that assumption. Everything downstream of that one design choice, every bracket, every audit flag, every loophole, flows from the simple fact that some income is easy to trace and some income is not. Watch how that gap widens as the number grows. $0 to $25,000. You file for money, not against it. You're standing in your kitchen in late January, and the mail brings a W-2 that says you made $19,400 last year working retail and a few months of gig delivery. You sit down with free software, plug in the numbers, and something strange happens. The refund line is bigger than what got withheld. You didn't lose money to taxes. The government sent you money back. The Earned Income Tax Credit, a program that can hand a single parent with 2 kids close to $6,600 on top of every dollar withheld. Your effective federal tax rate, after credits, sits around -4%. You are, on paper, a net recipient of the tax system. But the audit risk here is oddly high, about triple the national average for EITC claimants, because the IRS runs cheap, automated matching on this range and doesn't have to spend an agent's afternoon doing it. If your childcare provider's name doesn't match, or your address history looks messy, a letter shows up asking you to prove your kid lives with you. You dig through report cards and doctor bills to prove your own child is yours. It's a strange kind of scrutiny. The government trusts you least when it's giving you the most. You notice something else too if you pay attention. The letters never come with a phone number that gets answered quickly. You call, you wait on hold for 40 minutes listening to hold music that loops every 90 seconds, and eventually you either give up or get a representative who reads from the same script you already read online. The IRS spends less than $300 auditing a return at this level, but that $300 buys a form letter with real power. Miss the 60-day deadline to respond, and your refund freezes automatically, no human review required. You learn to keep every receipt, every daycare invoice, every custody document in a single folder, not because you did anything wrong, but because the burden of proof at the bottom of the income ladder falls entirely on you. $45,000 to $85,000, the paycheck you can't hide from. Now you're a couple years into a real job. $62,000 a year, W-2, standard deduction, maybe a 401k match you're finally using. Every 2 weeks your paycheck lands about 22% lighter than your salary implies once you count federal withholding, Social Security, and Medicare. Your effective rate after deductions comes out around 11 to 13% federal, and you feel every point of it because there's no accountant translating it into an abstraction. It's just less money on the 15th and the 30th. This is the most surveilled income bracket in America, and also the least audited in practice, because there's nothing to find. Your employer already reported every dollar to the IRS in January. You could try to hide income, and there would be nothing to hide. The computer matched your W-2 to your return before you even opened the software. About 96% of the tax owed in this bracket gets paid automatically through payroll withholding, which is exactly why the IRS loves you and barely thinks about you. You are the fuel of the system, not a target of it. You start noticing the small mercies built into this bracket too. The standard deduction, around $14,600 if you're single, nearly double that if you're married, means you don't need a shoebox of receipts to lower your bill. You just take the number the government hands you. Your biggest financial decision of the year is usually whether to bump your 401k contribution from 6% to 8%, a decision you make in an HR portal in about 90 seconds, and it quietly shaves a few $100s off what you owe without you ever thinking about it as tax strategy. You're not gaming the system. You're barely aware the system has levers at all, because at this income, the only lever within reach is the one your employer built into the benefits enrollment page. $150,000 to $400,000, the bracket that punishes ambition. You get the promotion. Base salary jumps to $210,000, maybe with a spouse also working. Household income crossing $340,000. You expect to feel richer. Instead, your accountant, because now you have one, tells you that you just walked into the 32 or 35% marginal bracket, that your child tax credit phases out, that your ability to deduct state and local taxes caps at $10,000, even though you're paying 4 times that in property tax and state income tax combined. Your effective federal rate lands around 22 to 26%. And once you add state tax, Social Security, and Medicare, you can watch nearly 40 cents of every additional dollar disappear before it reaches your account. This is the bracket where people first discover the alternative minimum tax exists, a parallel calculation that recalculates your bill under different rules just to make sure you didn't dodge enough. You start maxing out a 401k not because you love retirement planning, but because it's the only lever you have. Every other deduction has quietly vanished as your income climbed. Roughly 1 in 9 returns in this range gets a correspondence audit letter, almost always about a mismatched 1099 or an overstated business expense, not because anyone thinks you're a criminal, just because the software flagged a number that didn't fit the pattern. You also feel for the first time the strange sensation of being taxed on money you never touched. Restricted stock units vest, and suddenly $40,000 of phantom income shows up on your W-2 in a single pay period, taxed at a flat 22% withholding rate that almost never covers your actual bracket, leaving you a surprise bill the following April even though you never sold a single share. You start reading about backdoor Roth conversions on finance forums at 11 at night, half convinced you're missing some trick everyone else already knows. And half right. $500,000 to $2 million. You stop being an employee and start being a business. At this level, the paycheck usually isn't a paycheck anymore. You're a physician with an ownership stake, a consultant running an S-corp, an agency owner who finally cracked 7 figures. And the tax code changes its personality completely, because now you're not reporting wages, you're reporting profit, and profit is negotiable in a way wages never were. You pay yourself a reasonable salary of maybe $180,000 and take the rest, say $620,000 a year, just by choosing the right entity structure. Your effective federal rate, after a CPA who costs you $8,000 a year works the qualified business income deduction, retirement plan contributions, and depreciation on a home office and a vehicle, settles around 24 to 27% instead of the 35+% your marginal bracket would suggest. You're still writing real checks to the IRS, often a quarterly estimated payment north of $40,000, 4 times a year. But for the first time in your life, the size of the check is partly a choice you made in March, not a number a payroll system calculated for you in silence. $5 to $20 million, the entity maze. You sold the business, or the fund had a great year, or the equity finally vested. Now you're not filing one return, you're filing a return that references 4 or 5 other returns. An LLC holding company, a management entity, maybe a real estate portfolio bought specifically to generate depreciation losses that offset the gain. Your tax team isn't one guy anymore, it's a firm. A CPA who specializes in your industry, a tax attorney who reviews the structure once a year, and a wealth manager who times your stock sales around tax loss harvesting. Your effective federal rate can range wildly here. I've seen it sit as low as 19% and as high as 31%. And the difference almost never comes down to income. It comes down to whether the income was capital gains taxed at 20% or ordinary income taxed at 37%. $1 of long-term capital gain and $1 of salary are not the same dollar anymore. They're 2 different citizens of the tax code with 2 different passports. You start timing life events around the calendar, closing a deal in January instead of December, exercising options in a year you also have a large deductible loss, because at this level, when you make money matters almost as much as how much. You also start hearing a phrase you never encountered before, tax loss harvesting. Your wealth manager sells a losing position in November not because the investment failed, but because the loss, banked on paper, can offset a gain somewhere else in the portfolio dollar for dollar. It feels almost impolite the first time someone explains it to you. Losing money on purpose, as a strategy, in a system where losing money on accident at $60,000 a year just means a smaller grocery budget. $25 to $75 million. You stop reacting to the tax code and start planning around it years in advance. This is where trusts enter the picture. A grantor-retained annuity trust that lets you pass appreciating stock to your kids while freezing its taxable value today. A donor-advised fund that lets you take a $2 million charitable deduction this year while the money sits invested and gets distributed to actual charities over the next decade. Life insurance structured specifically to move money to heirs outside the eventual 40% estate tax. None of this is secret or illegal. It's published tax law, but it requires a minimum of 6 figures in annual advisory fees to execute correctly, which is exactly why almost nobody below this bracket ever uses it. Your effective income tax rate might actually look similar to someone earning $2 million, somewhere around 23 to 28%. But the real story is what happens to the money that isn't spent. Unrealized gains on stock you haven't sold aren't taxed at all under current law. So a founder holding $60 million in appreciated shares can borrow against that stock at 4% interest, live on the loan, and never trigger a taxable sale. It's a real strategy with a real name: buy, borrow, die. And it means the tax bill on paper wealth can functionally be deferred for a lifetime. $100 million and up, the family office level. At the very top, you don't file taxes. Your family office does. A dedicated team of 12 to 20 people, accountants, attorneys, a chief investment officer, exists solely to manage your capital and your obligations to the government, running roughly $3 to $5 million a year in overhead just to keep the machine running smoothly. Every major purchase, every gift to your kids, every real estate acquisition gets modeled for its tax consequence before it happens, sometimes years before it happens. The IRS, for its part, has a dedicated unit, the Global High Wealth Division, built specifically to audit people at this level, because a single audit here can recover more revenue than 1,000 audits of $60,000 earners combined. When they do come, it's not a letter, it's a multi-year engagement with subpoenaed records and a team of forensic accountants on your side, answering a team of forensic accountants on their side. And yet, because of the strategies stacked over decades, trusts, foundations, opportunity zone investments, charitable structures, the effective tax rate on the growth of a fortune this size frequently lands below 15%, lower than the couple making $85,000 a year with 2 W-2s and a standard deduction. That's the part worth sitting with. The tax code was written as a ladder where the rates climb as you climb. In practice, it behaves more like a maze where the rungs matter less than knowing which doors exist. The person at $60,000 experiences the tax code as a fixed sentence. The person at $60 million experiences it as a design problem with a team dedicated to solving it. Same law, same country, 2 entirely different relationships with the same government. The system isn't rigged in the sense of anyone breaking a rule. It's rigged in the sense that the rules were written by and for people who could afford to understand every one of them. Knowing which tier you're standing in and which doors are actually open to you might be the most valuable financial education nobody ever hands you for free. If this opened your eyes to how differently wealth is treated, hit like and subscribe for more.